And it's not very often that you can do a transaction and then be producing within 6 months in a tier one jurisdiction such as the Northern Territory in Australia. So, yeah, very exciting times for us.
Hello, you're watching Proactive. I'm joined by Pan African Resources CEO Cobus Loots. Cobus, very good to speak with you again. You're up to your first half results, and although you've reported a dip in production due to delays at your Evander underground operations, that should more than even out in the second half. And you've also had the benefits of that very strong gold price.
Yeah, so the performance of the Evander underground was disappointing. A delay in the commissioning of the subvertical shaft. So that shaft is now commissioned, and we are ramping up. So as you say, much better performance expected in the second half. But then for the most part, that reduction is also made up by or compensated for by early production from our MTR project, which obviously was delivered ahead of schedule and below budget in October of last year. And I mean, that's going to be a fantastic asset for our group. We are expecting MTR to be producing for 20 years, 50-odd thousand ounces a year or more at an all-in sustaining cost of $1,000. So that positions us certainly very nicely for the second half of the year.
You do say in the RNS, Cobus, that from the Mogale Tailings Retreatment Project, you're doing several studies to see how you can increase that production. Tell us a little bit about that.
Yeah, so certainly short term, we think we can probably increase production from 50 to 60-odd thousand ounces a year, and in the next year by quite a number of simple initiatives and fairly inexpensive projects. So I think that's attractive. But then in September of this year, we would also have completed a feasibility study into a standalone new operation to remine our Soweto cluster. So I mean that means you can pretty much if we then make a decision to proceed, you can almost double the size of current production from that part of the world.
I think probably very interesting to investors was to hear your plans for Tennant Consolidated Mining in Australia following that acquisition back in December. Tell us what you expect from that. Are you on track for production come the middle of the year?
Yeah, certainly. I mean, it was, I think, very exciting for us to conclude that transaction in December of last year. And it's not very often that you can do a transaction and then be producing within 6 months in a tier one jurisdiction such as the Northern Territory in Australia. So, yeah, very exciting times for us. The plant's pretty much built. So we expect to start or commence production in April, and then similar to MTR, will be ahead of schedule and on budget or below budget. So that's great. And then there's a huge ramp up plan for next year. So our guidance for next year out of Australia is between 48 to 60,000 ounces. And as you say, that then means that 60% or more of all of our production would be sourced from low cost surface operations.
And in fact, you do say that Tennant would make up about 20% of current production, but there's a lot of scope for further growth there.
Yeah, most definitely. So, I mean, we're optimizing our mine plans. Our current life of mine is 8 years, but we think there's definitely huge potential to expand that. And I mean, at this gold price, the cash flows are certainly very compelling.
How about the operations across your other operations, Cobus?
Yeah, so I mean, our surface business ticks along or continues to tick along. Great performance in the half from Elikhulu, which will be sustained. MTR is ramped up, so full 6 months of production from there. BTRP is doing very well, lowest cost producer in the group. As I said, the subvertical shaft at Evander is now commissioned, so we are ramping up production. And then Barberton Fairview will continue to tick along, and Consort positively has increased production. And then the last mine at Barberton will optimize in the next couple of months. So overall, I think our portfolio is in good shape.
And you mentioned that high gold price, Cobus. So $2,900, that must be great for your operations in South Africa and also those new operations in Australia.
It's excellent. Also, in terms of this set of results, we still had a hedge that we had to enter into to part fund the construction of MTR. So that hedge over the last 6 months, the opportunity cost was $18 million. And it now rolls out or rolls off completely at the end of this month, at the end of February, whereafter we'll have and our investors will have full exposure to the dollar and rand gold price. So that's very good for us.
So despite that minor setback with Evander in the first half, you've maintained your full year production guidance of 215,000 ounces. What's it looking like so far the second half, Cobus?
No, I mean, we wouldn't be putting out that sort of guidance if we weren't fairly comfortable and confident. But then, importantly, there's a huge ramp up in production in FY26 with a full year of production from MTR and a full year of production from TCMG. So our guidance for the next financial year is 270 to 308,000 ounces, which is obviously a very material increase.
I hope you'll keep us posted on any progress with that. Thank you very much for taking the time today.
Thank you for having me.
That's Cobus Lutz, the CEO of Pan African Resources.